Ji, Bismillahirrahmanirrahim. Hello and Assalamu alaikum to everyone, and I welcome you all in day 2. This is MA F2 Practice to Pass webinar, which is being organized by ACCA Pakistan for June 2021 exams. And this is day 2, 18th May. And I am your tutor, Hanif, and this is my WhatsApp number. You people can contact me at this number. First of all, I would like to ask all of you whether my voice and screen is all clear to all of you. I need confirmation as you people gave me the confirmation in the last session in the first day. Is everything fine? Voice, screen is all clear? Okay. I'm seeing the name that most of the students who are giving me the response, they all were present yesterday. And I appreciate, as always, I appreciate it's a two-way communication. You people should also participate in this webinar through your typing in the question box. Okay, so as I have told you yesterday that day 2, the agenda of day 2 is the project appraisal. In the day 1, we had covered budgeting, and this is day 2, and in the day 2 the agenda was project appraisal. So I'm now going to start the topic of project appraisal. And first of all, before going to start the topic of project appraisal, I would like to share the importance of this chapter, that this project appraisal, which includes the calculation of time value of money, which includes net present value, internal rate of return, and other financial techniques. And the importance of this chapter is that whenever you will be studying in future the paper FM financial management, this chapter will be acting as a base. This will be the base chapter for your future studies. So from the perspective of exam and from the perspective of MA exam, this chapter is also important. Why? Because this chapter may includes the exam may include the MCQs from this chapter, even the case-based OTQ, which we had done yesterday. And I'm going to show this thing again, that after the MCQs, I have also the case-based OTQ of this chapter were 2 marks, 2 marks, 1, and it becomes total 10 marks. Okay, so it quite may be possible that you may also be receiving the case-based OTQ from this specific chapter, or it may be possible that a single case-based OTQ would be examined, which covers mixture of budgeting and the project appraisal. I do repeat, it may be possible that you would be receiving one single OTQ, and the one single OTQ worth 10 marks may also include budgeting as well as the project appraisal. Okay, so again, I'm going to say one thing, that it's my well assumption that you have already studied this chapter, but don't you worry, as you people aware of the fact that I do start with a very basic, and we have got some calculations and all that stuff. We have got many things. All right, so but still your studying, your learning speed should match this webinar, because this is not a fresh class. This is just like a crash class. This is a revision. This is a practice to pass session. Okay, so but in this practice to pass session, as I have told you yesterday, that the main objective is to revise all the core areas and prepare you people so well, so that you may be able to pass out the exam. Okay, that was the main agenda. And yesterday I had shared, let me share it once again, that this was my day 1 slide, and this was the agenda. This was the agenda. Yesterday we had covered budgeting, and today is the project appraisal day. And I had made it clear that these three areas are the core areas, which becomes at least 30 marks, but also include more than 30 marks as well. So let's start with this agenda of today's class, that is a project appraisal. And here we go. All right, students. So I'm now going to start the topic of project appraisal in this day 2. First of all, let's analyze the word project appraisal. Project is anything. Project is anything which you will be undertaken in order to decide whether or not to invest. What do you mean by the term appraisal? Appraisal means evaluation. Appraisal means evaluation, or you can say it means assessment. All right. But usually we use the word appraisal for the past performance, but project appraisal does not include the past performance, but it includes, see what is written, project appraisal involves analysis of the projects in advance. Analysis the projects in advance. See what is written, in advance, and deciding which project should be opted and which project should not. You are evaluating the projects in advance. Okay, you are evaluating the project in advance in order to decide whether or not the project should be opted, whether the project should be opted and which project should not. Now, the second point is that project appraisal, it considers the time value of money. First of all, this chapter this chapter includes the time value of money. But what is actually the time value of money? See, the time value of money, it is the worth of money. See what is written, it is the worth of money that will change with the passage of time through the effect of interest percent. Example, example. See, for example, today is today is 2021. For example, today is 2021 and it's 1st January. Okay, today is 2021 and 1st January. I have dollar 10,000 in my hand, and I am now going to invest. I'm now going to invest. For example, I am going to invest in a bank, for example, at 15% interest. And this 15% interest is per annum. This 15% interest is per annum. Okay. This is something, this is something which I have got today's worth, today's worth. And after 1 year, 10,000, it will be 10,000 plus 15%, that will be $11,500. That is worth after a year, worth after 1 year. What is happening here? This is time. This is time, and this is the value. This is the value, and the value will change after 1 year of time. And this is known as the time value of money. What is exactly the time value of money? The time value of money means that what is exactly the worth of your amount, the worth of your money which you are holding right now in your hand, or maybe it is somewhere retained in the bank or wherever. So this is the worth of money in today's value, and after 1 year it will become, or it may become, 11,500. See the value, this is the value, this is the value, and in the middle it had passed 1 year of time. So that is simply the terminology, that is the time value of money. People often get confused that what exactly mean by the term time value of money. It is very simple. The worth of something. You can say that there is a cash in your hand, that is $10,000. It will be the value will be added in your money, and the value will be added when the money will be multiplied, when the money will be added through the investment. So this is known as the time value of money. And in this simple example, your worth, and in this simple example, your worth of your amount is increasing by 15% in 1 year. This is simply the time value of money. Okay, I'm not going to address the answer which is already being addressed. Mr. Azhar, you were not present in yesterday class, so it has been communicated to you that the recordings are available on vimeo.com/ACCA Pakistan. Walaikum Salam, Yusuf. Yes, this is the first slide. This is the first slide, and today's agenda I can show you. This was an introduction, and this is the first slide. And in this today's agenda is about the project appraisal. All right. So up till now, any question to any of the student? Up till now, any question to any of the student? Because in the next slide I will be starting with the calculative examples. Is there any question? Please feel free to ask and type. Is there any question to anyone? Okay, Usman. Basically, your money will be doubled with the interest percentage. With the interest percentage. That is why. Because if you have got the value today, for example, 10,000, and in 10,000, 15% that will become 1,500 is added, then it will become the future value. Okay. Okay, sure. I am repeating the example again. Uh, Mr. Sagar, listen it again. See that time value of money. I have got 10,000 today. If I will be investing this amount at 15% 1 year, then I will be having 11,500. See, this is the value. This is the value after 1 year. This is the value in today's term. And in the middle, it pass 1 year. That's the time. So that's known as the time value of money. That's known as the time value of money. Time value of money means time value of money. That is, with the passage of time, your amount will be added. Okay. So let's move ahead. This is something which is written here: present value and future value. See, present value. I'm not going to back this slide. In this exam, in this 10,000, there is no interest. There is no interest. So it is the present value. In this 11,500, there is interest element added. This is known as the future value. Future value, expected future value. Okay. So what is the present value? See, present value. This is the value of money. This is the value of money in present times. That means no interest included. This is the this is the this is the in uh, this is with no interest included. Okay, Usman, your question is that, sir, if the worth is same, how could we say that interest? Because worth is not same. Example, I have got 10,000. Okay, if I will be adding 15% interest, it would become 11,500. The amount is changed. The amount is changed. Osman, the amount is changed. This is my future value and this is my present value. And in a middle, there is an interest element and that will be change your worth. Okay. And next is the future value. Future value. This is the present value and this is the future value. Future value is the value of money expected in future times, includes the element of interest. It includes the element of interest. Okay. So that means we can simply conclude that like that way. Uh, in present value, you will be adding interest and you will get your future value. Okay. Present value and the future value. And that will totally change the value of your money. Now, the next point is about the compound interest. The next point is about the compound interest. What is the compound interest? What is the compound interest? See, compound interest means the interest will be applied initially on the principal amount. The principal amount is basically referring to the investment, your investment. The interest will be applied initially on the principal amount, and then interest will continue to be applied on the whole figures. That means interest in the previous period will also earn interest in the later period. Now, what will be happening? I'm now giving you a very short examples, and I appreciate that you people should copy this. Assume that I have got investment of simply $1,000 and my interest is 10% per annum. Okay. So if I will be analyzing that what will be happening after year one, what will be happening after year one? After year one, I will be having 10,000 plus 10%. It would become total 1100. Okay. This will be my worth of money after 1 year. Worth of money after year one. What will be happening after year two? Now, after year two, the interest will be applied on this whole figure. That will include 1100 plus 10%. 1100 plus 10%. It would become 1210. And this is my worth of money or the value of money after 2 years. Okay. And see that this 10% is applied on 1100, and in this 1100 interest is also included here. So that is the statement: interest earned in the previous period will also earn interest in the later period. That means interest will be applied on the interest, interest multiplied by interest. Interest will take the multiplier effect. This is the compound interest. After year three, it would become 1210 plus 10%, and this would become 1331, and so the cycle will be continued. This is the worth of money after 3 years. After 3 years. And now you might be confusing that why we are studying this thing. See, we are right now a management accountant, and the responsibility of the management accountant is to create the value for the organization in which you are working. Okay. And as a responsible manager, I should take initial steps for the better planning, controlling, and the decision making. And this is not the costing decision. See, this is not the costing decision. This is something, the decision from the financial perspective, that is whether or not we should make the investment for our organization to maximize the value of our organization. So we are playing the role of a management accountant, and being as a responsible management accountant, it is my utmost responsibility to create the value of for the organization. Okay, and the value obviously will be added when I will be earning money. And because cash is the lifeblood of any organization, so I should make a sensible, a rational decision whether or not the investment should be invested. And this is not my actual thing. These all are my future estimations. These all are my future estimations. These all are my future estimations. Why? Because you take that decision based on your estimated figure, okay? Because we usually estimate the things, then we are in a position to decide whether or not we should continue with this particular thing. For example, there is a distance from your home to the airport, near about 1 hour, and you are having your flight, for example. So you will be leaving your home 2-3 hours before, because considering many factors. Okay, so you are estimating many factors like traffic jam, like your boarding check-in, and all, and you will be taking the decision. What I'm trying to say with this simple example, that you first estimate the thing, and if according to your estimation you will take your decision, and these all figures are your estimations, that what if I will be investing the project at 10%, if I will be investing in a project at 10%, I will be having this amount after 3 years. If it is worthable in your perspective, if it is worthy in your perspective, you should go ahead and make this investment. So this all are estimations, and in this chapter we are not making the estimation for the cost. We are estimating for the money, for the interest, that what will be the amount, what will be the value of my money after 2, 3, 4, 5, 6 years, whatever. Okay, so this is the compound interest, that interest will continue to be added and added and added in the future. Okay, so this, and one thing very interesting, this process which we are doing right now, this process, and this process, and so continuing, this process which we are doing right now, it is termed as compounding. See what is written here, compounding. Compounding, it means converting present values into future values. I'm going back. This is my present value. 10,000 is my present value. And this is my future value. This is my present value, and this is my future value. Okay. So what I had done, I had converted my present value into the future value after 3 years, and the process is called compounding. It means converting present values into future values. Now, for example, I will not be calculating like that way. For example, the question is asking you that what will be the amount of your investment after 20 years. So for 2 marks MCQ, we will be repeating this thing 20 times? Not at all. We will be applying this formula. FV stands for future value. PV stands for present value. One is one. What is I? I means interest. And what is small n? N means number of years. See, last example, I mean the previous example, your investment was $10,000. Sorry, it was 1,000, I guess. Yes, it was 1,000. and your interest was 10% per annum, and just see the figure 1331 after 3 years. So I will be applying this format, that is future value is equal to present value. That will be 1000 multiplied by 1 plus 10%. Now this 10% will become 0.1. Why? Because 10% will be 10% is equal to 10 upon 100, and that is 0.1. Power 3, that is number of years. So if I will be calculating this, my answer, that is future value is equal to 1000 multiply 1.1 power 3, that will exactly be 1331. You can verify through your calculator. So 1.1 give a power of 3, give a power of 3, and multiply with 1000 that is after 3 years. Is it verified? All of you give response in the question. Is this simple calculation verified? So we will be moving for the next calculations. All of you please drop your answer. Okay, that's good. So this process is known as the this process is known as the compounding. Okay, now see this example. The company had principal amount 15,000. The company had principal amount 15,000, and the interest is 10% compound per annum. What will be the total value of money after 5 years? See, I am again writing the formula. Future value is equal to present value multiply 1 plus I power n. Okay, so this is my 10%. 10%. Future value is equal to present value, that is 15,000 multiplied by 1 plus 0.1 power 5. 5 is 5 years. So future value is equal to $15,000 multiply 1.1 power 5, and the final answer is, this is my future value after 5 years. This is my future value after 5 years. 1.1 power 5 multiplied by 15,000, and the amount is 24,157.65. I am using my own manual calculator, and I also encourage you people, do not just copy, just also calculate it. This is my time value of money. In today's term, I am having 15,000. Today I am having 15,000. But after 5 years, I will be earning maybe 24,000. So this is just my estimation that my worth of money will change, and it is simply the interest calculation. So this was the compounding effect. This was the compounding effect. Okay. Now, it quite may be possible that you may be having a reverse calculation, and obviously it will be happening. See, the next process is the discounting. Discounting. It means converting future value into present value. Discounting is a reversal. What do you mean by the term discounting? Discounting means converting future value into present value. That means we have to adjust this formula. Now I need to calculate present value. And how do we calculate present value? See, this figure is being multiplied, and it will be divided by future value divided by 1 plus I power n. This is a simple mathematical trick, but it is the mathematical trick that whenever something is in denominator and in that particular figure there is a power, so making it more simplified, present value is equal to future value. Now this thing will be shifting towards the numerator with the multiplying effect 1 plus I, and the important point is power will be in minus. So this will become the formula of calculating the present value. Present value is calculated as future value multiplied by this thing. And remember one thing, this thing is known as this thing 1 plus I power minus n. This is known as the discount factor. This is known as the discount factor. That is 1 plus I power minus n. This is the discount factor. This thing is known as the discount factor. So we can say that, and this is being multiplying, we can say that present value, it is the product. Product means multiple of future value and discount factor. I will be using the short word discount factor. Okay, so present value, it is the product of future value and the discount factor, and this is the simple trick to calculate the discount factor. And the discount factor will be available in your exam. There will be a sheet of the discount factor. It will be available in the exam either as a separate sheet, or either it will be included in the question in your computer screen. Okay, so remember this formula. Present value is calculated as future value multiplied by 1 plus I power minus n. And there is a sheet of discount factor. There is a sheet of discount factor. I will be displaying it here. See, this is the present value table. This is the present value table. And see, this is 1 plus R minus N. They are showing it like R. R means rate of interest. R means rate of interest, or we can use the word I as well. Interest, it's same. So 1 plus R minus N, minus N. See, this is minus N. Okay, so this is the discount factor sheet. This is the discount factor sheet. It quite may be possible that you will be having this sheet in your exam, or the particular extracts would be given in your exam. Okay, let's now solve the example, and I will be referring that discount factor sheet. Question: if 14,641 is to be earned in 4-year time, see, if you want to earn this amount, this is my future value. If you want to earn 14,641 in 4-year time, what is the present value? Interest is 10%. So how will we calculating the present value? Present value is equal to future value multiplied by discount factor. And that discount factor is this 1 plus I minus N. Okay. And discount factor I will be having for 10% and 4 years. 10% and 4 years. Remember this figure. So present value is, future value is 14,641 multiplied. This discount factor will be 4%, sorry, 10% 4 years. That is 10% and 4 years. 4 years, 10%. 1, 2, 3, 4. This is the amount. So 0.683. 10% year 1, 2, 3, and 4. So 6.683. 0.683. This is from the discount factor sheet. Using discount factor sheet. And see, it is written that to the nearest dollar. So that means my present value would be $10,000. You have to make it round off. This is the reversal calculation, that is calculating the present value. I'm waiting few seconds for you people if anything you want to note it down, because what I believe that I had explained in a very simple manner, and you will be in a position, inshallah, to solve the complex questions as well. Okay, after 20 seconds, I will be proceeding for the next slide. All right. So right now I am moving for the next slide, and the next slide is that methods of project appraisal. Methods of project appraisal. Okay, one thing more, that I have created a WhatsApp group. I have created a WhatsApp group as well for you for any kind of educational support related to your paper MA, even after the webinar or during the webinar. And the link of the WhatsApp group, the link of the WhatsApp group has been shared in your question box. It will be shared once again. Okay, it has been shared. It has been shared just half a minute back. It has been shared. Yes, it has been shared. And you can also contact me at this number. This is my number. If anyone, if is not able to join through the WhatsApp link, then you people can freely contact me at this my number. So I will be adding you. +92 333 311 3959. Okay. So now moving for this next slide. Okay, this was the discounting present value we had calculated. Now the methods of project appraisal. What do you mean by the term methods of project appraisal? These are the methods which is known as the financial techniques. The financial techniques. Financial techniques. I can say this is the financial techniques. Financial techniques analysis. Financial technique analysis of the project appraisal, that we are appraising the projects in advance, that we are appraising projects in advance. And we have got 4 different techniques in our paper MA. Number 1 is NPV, net present value, internal rate of return, IRR, payback period, simple, that is non-discounted, payback period, discounted cash flows. Obviously we will be studying one by one in the upcoming slide. But remember one thing, I would like to add one thing here. In all the financial analysis, we do not take profits. Confused. We do not take profits. Yes, we consider cash flows. We consider cash flow. And I had told you in the last class that profit is not equal to cash. Profit is not equal to cash, because profit also includes some non-cash expenses like depreciation. But cash means this is the physical cash, this is the actual cash flow. So this appraisal techniques, financial appraisal techniques, financial appraisal considers time value of money, time value of money, and money means this is a cash, not profits. Okay, so if in the question there would be profit, we need to convert it, into the cash flow. So financial appraisal techniques considers the time value of money, and that includes the cash flows only. Okay, so let's start one by one. This technique number 1 is the net present value. Net present value. See, this is a net present value. What is the net present value? It calculates, what is the net present value? It calculates the present value. See what had been written here. It calculates the present value of all cash flows, of all cash outflows. Calculate the present value of all cash um, of outflows. See, calculate the present value of all cash outflows. Remember one thing. Here it is written present value of all cash outflows. And then making the net figure by calculating the present value of all cash inflows. See, this is my present value of all cash outflows. This is the present value of all cash inflows, and this is the net present value. And the criteria is that if your NPV is positive, you should accept the project because it is giving you the positive net balance in the present terms, because this technique believes net present value. This technique, NPV believes the assessment in today's value. This is one of the technique. Okay, if your NPV is negative, you can simply reject the project. If your NPV is positive, that means accept the project. If your NPV is negative, that means reject the project. And what you are supposed to do to calculate the net present value, that is to calculate the present value of outflows and the present value of inflows and then net present values. Okay, so let's move for the question. This is the question, calculate the net present value of the project. But before going to start this question, there is a terminology which is cost of capital. Cost of capital. So first of all, we should understand what do you mean by the term cost of capital. This is very important thing which I'm now going to explain and write. As this slide is blank, I have to write it. What is cost of capital? Assume that you are a potential investor and you are not having the amount, and you will be borrowing it. Okay, Sagar, number in minus, it was number of years cannot be in the form of minus, all right, because it is a future decision. It cannot be in minus. Okay, now what's the cost of capital? Assume that I have got the cost of capital. What is the cost of capital? For example, I had borrowed. For example, I had borrowed $100,000. For example, I had borrowed $100,000, and $100,000 I had borrowed from a bank, that is, for example, 60,000, and I have to pay to the bank at 9%. For example, 60,000 at 9%, and 40,000, for example, uh, I had raised this amount 40% from preference shares. For example, preference shares, let's say, and that's 40,000, and the amount was 12%, for example. Now, what is the cost of capital? Cost of capital means you are now you will now have to pay interest to two different parties. Okay, you have to pay the interest to two different parties. How? 60,000 multiply 9%. You have to pay interest. 60,000 multiplied by 9%, it is 5,400, and 40,000 to 12%, 4,800. You are having total capital of 100,000 and your total interest is 4,800 plus 5,400. This is 10,200. Now what you are supposed to do? What you are now cost of capital simple means interest. Cost of capital means interest. I will be writing something here by writing or, but from this 10,000, from this 100,000, you have to pay total interest worth amounted 10,200. So your interest percentage is 10,200 divided by 100,000 multiplied by 100. Your interest percentage would be 10.2%. 10.2% is my cost of capital. It is a cost of capital. What is capital? 100,000. And what is the cost? 10.2. That means simple interest. Or cost of capital may also be the opportunity cost of cash holding. For example, I have a cash, my personal cash. I have my personal cash. For example, I have cash in hand, $200,000, and I've got the opportunity from bank to invest at 13%. I can simply invest my 200,000 at 13% to any of the bank. For example, it is a simple and open opportunity available to me that I can invest $200,000 in a bank at 13%. And if I will be investing this 200,000 at 13%, and for example, there is a person, Mr. A, he's coming to me and asking me, sir, that invest $200,000 in a project. Definitely I will be considering 13% because it's my simple opportunity. It's my simple opportunity. So 13% is my cost of capital. I want a response from all of you in the question box and must answer me whether you understand this, the principle of cost of capital. Just reply me in your question box. Cost of capital means interest which you can earn for the next in order to invest in the next project. Or if you are not having a single cash, for example, I do not have cash, I have borrowed it from two different parties, then I have to pay them 10.2%. So if I will be investing in a next project, obviously I will be demanding more than 10.2% because I have to pay 10.2%. Okay, understood this now? Okay, number two example is that this is the amount which I had borrowed. This is the amount which I had borrowed, and this is my amount which I have cash in hand. I can invest at 13% in a bank, and you are coming to me that, sir, invest that amount somewhere. So I will be charging more than 13% at least because this is my cost. And this is also my cost because I have borrowed it, and this is my personal cash in hand. Any of the scenario can make it the cost of the capital. Okay, Fiona, that's very good. Now, students, don't be confused about the cost of capital. It is not that deep understanding in your this syllabus, but I had explained you as a complementary thing. So in your examination, it will be simply you are having a cost of capital like that way, which I had written over here. Okay, so don't be confused about the cost of capital. Just remember one thing, that cost of capital is that the interest which you are supposed to pay to the party from where you had arranged the cash. Okay, now uh, again, net present value, net present value, net present value. See the thing what is written here, net present value. Again, you have to read out this net present value. What is the net present value? It calculates the present value of all cash outflows and then making the net figure by calculating the present value of all the cash inflows. Of all the cash inflows. Fine. So now I am going to solve this question. And what is the question here? The question, it worth 2 marks. Calculate the net present value of the project. Net. This is net present value of the project. See what had been written here. Baba Limited is deciding whether or not to accept a particular project or not. The company had estimated the following cash flows. The company had estimated the following cash flows. Year zero. Year zero means what? Year zero means now. Now means today. Means time of investment. Time of what? Investment. Now, Baba Limited is deciding whether to accept the particular project or not. The company had estimated the following cash flows. Year zero means 20,000 investment, and these are my future inflows. These are my future inflows. And in the last thing, it is written that in year 3 there is a cost estimated 2,000 to dismantle the machine. 2,000 to dismantle the machine. What is this 2,000? This is my outflow to dismantle the machine. Dismantle the machine. Okay, and this is the outflow. We need to calculate the net present value, and net present value will be calculated like that way. I am making columns, that is years, and that is cash flows, and cash flows are future values. Cash flows are what? These cash flows are my future values. Multiply by discount factors, you will be getting present values, because future value multiplied by the discount factor, and you will be in a position to calculate present values. Okay, so it's year zero. The cash flow is 20,000. Multiply. Discount factor in year zero is always 1, because this is year zero, this is now, and it will be minus 20,000 because this is now. Okay, year 1, year 2, and year 3. In year 1, the amount is $9,000. Year 2 is $15,000, and year 3 is 18,000 inflow and 2,000 outflow. Year 3. So that means it would become 18 minus 3. Sorry, 18 minus 2. 18 minus 2. That would become 16,000. Okay, that would become 16,000. These all are my future values, and that percentage is 12%. That's discount factor is 12%. Okay, now I'm opening that sheet. That is the 12%. 12%, 12%. 0.893, 0.893, year 2, 0.797, 797, year 3, 712, 712. These all are my discount factors. Calculate the present value. 9,000 multiplied by 0.893, that is 8037. 15,000 multiplied by 0.797, that's 11955. 16,000 multiplied by 0.712, that is 11,392. These are my present value of inflows, and this is the present value of outflow. So making it net, that is NPV, net present value would be dollar 20,000 plus 8037 plus 11955 plus 11392. That is NPV is plus 11384. That means project can be accepted. That means project can be accepted. This is the technique of net present value. Net present value basically calculates the present value of all your cash flows, whether it is inflow and outflow, inflows and outflows. Okay, so if your present value is in the positive, so you can accept that project. If it is in negative, you should reject it. I'm waiting 30 seconds for you people to copy. Okay, now students, we are proceeding for the next slide. Net present value, net present value. Okay, Usman, I am displaying you the last slide. And Razia Mukhtar, you raised a question, sir, can we calculate the discount factor manually without discount sheet? Yes, you can. You can for sure. Just write 1 plus I. What is the I? That means 1.12. minus year 2, you will get this figure. But take up to 3 digits. And since the sheet and the discounting factor values will be available in the question, so no need to spend time on that, what I believe so. Okay, ये लीजिए the slide number 8. The slide number 8. Have you taken the screenshot for that? Okay. Okay. And this is annuity. Now, what do you mean by the term annuity? What is annuity? Annuity means it is a constant cash flow. It's a constant cash flow for a defined time period. It's a constant cash flow for a defined time period. See, the point to be noted is that the cash flow is for the defined time period, for a defined time period. Okay. For example, that you have invested the amount in a bank and the bank is giving you $10,000 every year. So what is this? This is 10,000 is a constant cash flow, but the time period is already defined. And how to calculate the present value of annuity? Annuity is a constant cash flow for a defined time period, and the present value of annuity is calculated annuity multiplied by annuity factor. Now, what is annuity? Annuity is the constant cash flow. And now we will be taking the annuity factor, not the discount factor, but we will be taking annuity factor. If you want a manual calculation of annuity factor, that is 1 plus I minus n, that is the discount factor. Simply 1 minus discount factor divided by I. This is my annuity factor formula. Annuity factor is calculated as 1 minus discount factor divided by I. And again, the good news is that just like the discount factor, the annuity sheet will also be given. See, this is my annuity table. This is my annuity factors. And this is the manual formula to calculate. And I have also written here. You can note it down. Simply, annuity is a constant cash flow. And in order to calculate the the present value of the annuity, annuity is a constant cash flow multiplied by the annuity factor. Now, let's move for the question. Let's move for the question. See that note. Again, it is written that profit is not equal to cash flow. Profit is not equal to cash flow. Cash means it is the actual cash. It's the question. Just read it. Read this question kindly. It's saying you to calculate the net present value of the project. Again, we need to calculate the net present value. Just read out the question. Okay. Now what had been written here? MHH Limited is deciding whether to accept the particular project or not. The company had estimated the following: investment 50,000, that is in machines. Annual profit, see what is written, annual profit 3,000 for 5 years of project life. The company's cost of capital is 11% per annum, and company uses the straight line method for the depreciation. Now see that depreciation. Depreciation is a non-cash expense. Agreed? What's the depreciation? That's 50,000 divided by 5 years, isn't it? We calculate the depreciation like that, the cost upon useful life. 50,000 divided by 5, that is $10,000 per year. This is the depreciation. Okay, this is the depreciation. And the depreciation is a non-cash expense. And see, this is 3,000 is a profit figure. This 3,000 is a profit figure. And how does the profit figure would have been calculated? The profit figure was $3,000. That means this depreciation was deducted from here. This depreciation would have been deducted, and we have to simply add it back in order to make it a cash, and that would become 13,000 cash inflow. So that means 13,000 cash inflow. That means 13,000 is the cash inflow for 5 years. Okay, for 5 years. So what is the percentage? That is 11% and 5 years. And see, refer the annuity factor table. 11% and 5 years. 11% and 5 years. 11% and 5 years. 3.696. 3.696. And see how I will be calculating the present value. That is year 0. Cash flows. And that's now annuity factor is equal to present value. Is equal to present value. Year 0. That means 50,000 investment. The annuity factor is always 1 because it is now. That will be 50,000 minus. And from year 1 till year 5, my cash flow is constant. And as I have mentioned here, that present annuity multiplied by annuity factor. And what is the annuity? The annuity is 13,000. That is $13,000 for 5 years multiplied by 3.696. 3.696 is from the annuity sheet. 11% on 5 years. 3.696 multiplied by 13,000, that is 48,048. And now my net present value is minus 1952. So I cannot recommend to invest in this project. You can simply reject this project because it is giving you a minus figure in the present terms. You can simply reject this project. I want response from all of you that did you understand this annuity concept? Yes, Fiona. When it is the annuity, you have to take the you have to use the annuity figure, annuity table. Yes. Yeah, sure. Okay. Um, yes, Wakar, it will be uploaded on vimeo.com/ACCA Pakistan. Abdul Majid and Sweta, you have got same question. The same question, that how did we calculate it 13,000? See, this 3,000 is after the deduction. This is the profit figure. And while calculating the profit figure, we deduct the expenses. And obviously the depreciation expense would have been deducted. And it should not be deducted because we consider the cash flows. So we need to take the cash flows, and that is why I had simply added it back, because that amount should not be deducted, and that is already deducted figure, and that is already the deducted figure. All right. So we need to add it back. Okay. Yes, the presenting slides can also be shared, but it will be shared in the WhatsApp group. This slide can be shared and it will be in the WhatsApp group. So all of you are required to join that WhatsApp group. Okay, let's now proceed for the next thing. This is something very important to note. Is use a discount rate of 8%. See what had been written here. Smith has to make annual payment of $1,000 on 30th June each year until 30th June 2021. Today's date is 1st July 2015. That means count the years. 2015 till 2021. How many years? 6 years. 6 years, 8%. And $1,000 in annuity. $1,000 in annuity. So present value of annuity is annuity multiplied by annuity factor. Annuity multiplied by annuity factor, and annuity factor we will be using 6 years and 8%. So what is the annuity? That is $1,000 and 8%, 6 years. That's 8%. 1, 2, 3, 4, 5, 6, and that is 6 years. 2, 3, 4, 5, 6. 4.623. 4.623. 1, 2, 3, 4, 5, 6. 4.623. 4.623. And this is my answer. 4.623. Okay, so multiply by 1000, that will be given me 4623. This is the present value of annuity. And remember one thing, the main point to be noted is that all the amount are in arrears. All the amount are in arrears right now. Now what do we mean exactly by the term arrears? This all the amount 1000, this is my answer. Okay, point to be noted is that all the amounts are in arrears. Arrears means after 1 year. That means everything which you are receiving is after passing of 1 year. That is after passing of 1 year. Okay, after passing of 1 year. Remember, after passing of 1 year. Okay, next. The question is something different. The question is saying in advance. Annual rental payment is 12,000 payable each year in advance. Each year in advance. 5%, 16 annual payments. Present value of annuity is equal to annuity multiplied by annuity factor. And annuity factor is now. Here is something different. It is in advance. It is in advance. Advance. It is in advance. First of all, do tell me, when will you make the first payment? The first payment is now. Now, because here it is in advance. So that means if something is in now, the present value is already 1200. Now, how many remaining payments are there? The remaining payments 15. So we will be using the discount rate for 5%. 5% on 15 years. 5% on 15 years. That would become 1200 multiplied by 5% and 15 years. 10.380. 10.380. So 10.380 multiplied by 1200, that is $12456, because it is in advance. So do not try to adjust the formula of the discount factor, that whenever it is in written form, in advance form, just add one. Just be simple and natural. First payment you have to make it now in advance, and remaining are the 15 payments. So simple. So this is 1 and this is 15. Collectively it would become the 16 payments. So that will be the total present value of annuity. Make the things simpler. That is $13,656. This is the present value of annuity when the cash flows are to be paid in advance. Okay, Fiona Trish, I will be displaying you the last slide, but first copy this. I'm waiting just 20 to 25 seconds. Okay, now I am displaying the last slide for 15 seconds. This was the last slide. Hurry up. Okay, probably you people have noted it down. And this was in arrears. Arrears means after passing of 1 year, and advance means in advance. Okay, So I do suggest to all of you that make your calculation simpler. First payment is to be made now because it is in advance, and remaining are the 15 payments, so totaling 16 payments. No problem at all. Okay, so this is my present value of annuity. Present value of annuity. Okay, now we are proceeding for the next slide. And this is the discount rate and NPV relation. Discount rate in discount rate, and this is the net. This is a very simple relationship to understand that why they have got the inverse relation. Why they have got the inverse relation. This is a very simple. This is a very simple. NPV means your benefit. NPV means your benefit. Discount rate is your cost. Cost of capital. Cost of capital. See, it is very simple relation. When cost increase, that means benefit decrease, obviously. So that means there will be the first change in discount factor, and second responding change in net present value. Second responding change in net present value. So that means when your discount factor increases, that means net present value decreases. So here I'm writing something. I'm writing something here. For maximum positive NPV, the discount factor should be low. The discount factor should be low. Okay. So there is a inverse relation. Cost of capital and the discount factor and the net present value, there is inverse relation. Okay, this is an inverse relation. Hurry up, waiting just 20 seconds. Okay, let's now move for the next slide. And the second thing is internal rate of return. See, I have told you that there are four techniques which we are going to study. Number one was net present value, which we had done. Number two is the internal rate of return, IRR. What is IRR? It is something the discount rate at which net present value is zero. How? I'm giving you a very simple example. Example, if my discount factor and my net present value. See, imagine if my discount factor is 3%, the net present value would be 11,000, for example. If I will be increasing it to 6%, the net present value will fall. For example, it will be 6,000. If it is 7%, that it means it is 1,500. If it is 8%, the net present value would be zero. If it is, for example, 9%, the NPV would be minus 500. This 8% is the internal rate of return. This is IRR, internal rate of return. This is that discount factor. This is that discount factor where you are having zero NPV, and you can call it internal rate of return is your break even point. It is your break even point. So this is a simple formula, and you have to memorize this formula. You have to memorize this formula. This will not be given in the exam. You have to memorize it. Okay, not given in exam. See, you have to memorize this formula. What is written here? IRR is equal to small a plus capital A upon capital A minus B, B minus A. And you might be you might have studied in a positive and a negative manner. I am also explaining in a very simple manner. Don't be confused in positive and negative. Just follow what is written here. Small a means discount factor where NPV is higher. B is that discount factor where NPV is lower. A is the amount of high NPV, B is the amount of lower NPV amount. Okay, so let's move on to calculate the IRR. See, what this is the A family and this is a B family. This is positive, sorry, higher NPV is capital A. This is negative, sorry, no negative. This is a lower NPV, capital B. This is small a and this is small b. Okay, all right. So you just have to find out the higher and the lower amounts. And what is IRR? Sir, IRR is equal to A plus capital A upon A minus B, B minus A. This is my IRR, and that is internal rate of return, that is A is 5 plus capital A 12,000 divided by 12,000, and this is minus in the formula. Okay, minus, and B is minus 3,000, that is minus 3,000, and that is 12 minus 5. So IRR is equal to 5 plus 12,000 divided by, this is minus minus plus, minus minus would be plus, and this is 15,000 multiply by 12 minus 5, that is 7. So IRR is equal to 5 plus 12 upon 15 multiplied by 7, that is 5.6. And now the IRR is 10.6. So that means if discount factor is 10.6, then project is having NPV 0. Then project is having NPV as 0. Okay, let's now turn on to the next page. And the next point, the next question is, yet you have got 4 different NPVs and 4 different discount rates, and we have to select high and the lower. It's not the high-low method traditionally. It's something which we have to go to the zero. I'm giving you a very simple example here. See, this is something 0. Here it is 7%, 9,500, this amount. And furthermore, wait, at 5%, your NPV is plus 13,500 at 5%. At 7%, the NPV is 9,500. At 12%, the NPV is 3,000. At 14%, the NPV is minus 4,500. First of all, do tell me, we have to go to 0 NPV. We have to go to 0 NPV. NPV, we have to go over there. And here it is plus 9,500. And here it is plus 13,500 NPV. See the NPV. And here it is minus 3,000. And here it is 4,500. We have to go to the 0. We have to go to the 0 NPV and select those two figures which are near to 0. Select those two figures. Select those two figures which are near to 0. And near to 0, we have got these two figures. So we will be selecting this and this because we have to go to the 0 NPV. Fine. So we need to take these two figures. Calculate IRR. IRR is equal to A plus capital A upon A minus B, B minus A. So that is IRR 7 plus 9,500 upon 9,500 minus 3,000 and 12 minus 7. And I am calculating the direct answer. Just calculate it. Select those figures which are near to 0. Because it is a very simple thing that if you want to go somewhere, you have to take a very simple route. Do not go like a very long route. Just take the simple route. And the answer is 10.8. 10.8 is my answer. This is my internal rate of return. All right. So let's now move on to the next question. And the next question is yes. See what is the next question. Why I have not emphasized on the positive and negative figure. Why I have emphasized on the higher and the lower figure. See, at 7%, the NPV is 18,000. At 9%, the NPV is plus 15,000. That means my IRR will be after 9%, because the NPV would be reducing after 9% as well. So these are two, and these are two positive figures. No need to worry about the plus and the negative sign. I'm not going, this is the higher figure. This is A family and this is B family. A and small b. Okay, now IRR is equal to A plus capital A upon A minus B multiplied by B minus A. That is 7 plus 18,000. Now 18,000 minus 15,000 multiplied by 9 minus 7. Keep the thing simple. That is 19%. At 19%, the NPV is 0. At 19%, the NPV is 0. So that is why I was not taking the positive and negative sign. Azhar, I have told you take the higher and the negative and the lower figure. Yes, Usman, it is necessary to because imagine that you have to go somewhere and there is a shortcut street towards your destination. Why we are taking the long route? So that is why we have taken those two figures which are near to 0. Okay, Usman. Azhar Ahmed, it is how to decide the A and B. A is something which is higher and B is something which is lower. Okay. Azhar Ahmed, is your query addressed well? Answer me. Okay, Usman. Okay, that's fine. Now, now what is the decision making criteria for IRR? Sorry, the decision making criteria for IRR. Compare IRR with the company's cost of capital. For example, see that at 5% discount factor and net present value. See that at 5% there is 15,000. For example, at 7% there is NPV plus 9,000. Let's take rough examples. For example, at 9% it is plus 1,300, for example, and at 12% the NPV is 0, and at 15% the NPV is in negative 5,000. Now do tell me, this is my internal rate of return, this is my IRR, 12% is my IRR, and what I will be preferring, I will prefer this discount factor because of a very great margin of safety. So that is why if IRR is greater than your cost of capital, accept the project. If your IRR is, for example, if your IRR is less than the cost of capital, what if my cost of capital is 15%? The NPV would be negative. Because if IRR is greater than the cost of capital, except the project, it would generate positive NPV. See, IRR is greater, 12%. I appreciate 5%. So that means 12 is greater than 5. That means a very, very positive NPV. Okay. Very, very positive NPV. If my IRR is less than cost of capital, reject the project. It would generate negative NPV. If your IRR is exactly equal to the cost, still the project can be accepted because NPV is 0, no loss. Project can be accepted to run the cycle of the business. But what is the preference? Your internal rate of return should be greater than your cost of capital, because it will generate you the positive NPV as I have demonstrated in the above simple imaginary figures. Is it clear? All of you, is it clear? Okay, now we are taking a very short break. We are now taking a short break. According to me, it's 12:40 now. According to me, it's 12:40 now PST. I will be resuming at 12:55 or just before 1 p.m. Before 1 p.m. Okay, it's just 15 to 20 minutes. I will be back. And okay, Vakar, I will be explaining it after the break now. So your break time starts now, and I advise all of you, do not disconnect this webinar. Stay connected. We will be resuming, inshallah, after 15 to 20 minutes. Okay, your break time starts now. Yes, hello everyone. We are now back from the break, and can you people just confirm me that my voice and screen is all clear to all of you? My voice and screen is all clear to all of you. I again need a confirmation. Okay. So resuming from this, Mr. Wakar, you had raised a question that why is it so? Are you here, Wakar? Wakar, are you here? So that I can repeat this thing once again. Okay, see that I am removing these two figures. I am removing these two figures. Okay, just forget it. Forget these two figures. Assume that at 12% the NPV is zero, and at 5% your NPV is positive. What will you expect? What will you expect that your cost of capital should be 5% or 15%? Just answer on the question box, Mr. Vakar. You what will you expect that your cost of capital should be 5% or 15%? 5%, obviously. That is the written statement here. IRR exceeds cost of capital. That means accept the project because here the project is having the positive NPV. Okay. And if IRR is less than the cost of capital, I prefer this cost of capital. I prefer this cost of capital because when I will be going to the bank in order to raise the finance, I will be negotiating that my cost of capital should be less than 12%. That is, IRR should be greater than the cost of capital. The project is positive NPV, otherwise negative, and hence here. I hope you now you do understand it. Just drop your answer. Hurry up. I hope you do understand it now. Okay, that's great. You're most welcome. You're most welcome. Okay, let's now proceed for the next uh, target, and that is the payback period. See, what is the payback period? The payback period is simply this is the payback period is the time period. It is the time period expected in which initial investment is expected to be recovered. Note, no consideration of profits, only focusing on the initial investment. And obviously that project will be selected where payback period is low. For example, there is project 1, there is project A, its payback period is 2 years. For example, there is project B, the payback period is 4 years. Which project will you accept? 2 years or 4 years? Which project will you accept? Project A or project B? Your initial investment. Yes, obviously, I will be preferring this thing because that project shall be selected. That project shall be selected, which is in which there is low payback period because everybody wants to that initial investment to be recovered as soon as possible. Okay, so here I am writing the statement. Here I am writing the statement first. Point to be noted is that that project should be accepted which has low payback period. Okay, which has low payback period. That project should be selected. Now, this is the example. There is a project which is expected to give the cash inflow 25,000 per annum. 25,000 per annum, that is the annuity. And the initial investment is 7,000. Calculate payback period. See, I'm writing here when the cash flows are constant. Annuity. That means imagine my investment is 75,000 and every year I am receiving 25,000. So that means 25, 25 and 25 equals 75,000. That means year 1, year 2 and year 3. So payback period is year 3. But when the cash flows are constant, so simple payback period is investment upon constant cash flow. My investment is 75,000, and every year I will be receiving 25,000. So that means 3 years. 3 years is my payback period. Payback period is my 3 years. My payback period for this particular project is 3 years. And remember this thing, that this formula will work. This formula will work when the cash flows are constant. That is investment divided by a constant cash flow. That is 3 years. 3 years is my payback period. And this is all my expectations. These are all my expectation, that it is expected that my this project will give me my initial investment back after 3 years, and afterwards I will be starting earning the inflows. Students, I would like to say something about something distractions and rumors which are spreading in the market regarding the examination, whether it will be remote based or center based. So I would like to add one thing, because many of the students from Pakistan, from India, from different other countries are sending me the messages regarding the papers and all that stuff. So I would like to add one thing, that uh, avoid the distractions. Avoid the distractions, because if you will be focusing on the distracting words, you will have distractions. Just go for the solution. What I prefer is that whether the exams, whether you are in I don't know the students from which countries are here in this webinar, but wherever you are, either from Pakistan, India, Bangladesh, Sri Lanka, UK, or wherever, Saudi Arabia, wherever. So I would like to add one thing, that just focus on your preparation. Just focus on your preparation, and focus that and allow yourself to prepare like that way, that whether the exams will be remotely conducted or in center based, I should be prepared according to my syllabus, according to my contents. It does not matter that I will be taking the exam in remotely invigilated format or the center based. My main objective as a student should be that I have to pass out the paper, and for that we have to stay in touch with ACCA. Okay, so because I have seen a lot of miscommunication from the student side, from here and there, and the rumors and all that stuff. So I don't prefer that you will be in such kind of rumors or the distracting words. So just focus on your study. Focus on your study. Prepare well. Prepare well for your paper. That's all. Prepare well for your paper, and go to the ACCA website, find out the scratch pad, practice more. I will also be displaying it in my this webinar somewhere today, tomorrow, wherever. In this webinar session, I will be showing you the website of ACCA, where you can get the scratch pad and your practice session as well. So do practice. Do not stay in touch with the distracting words. Stay in touch with your studies, with your ACCA and all that stuff. Okay, so if you are willing to appear for the examination, that you must have to prepare well. Okay, and also pay your subscription if anything is outstanding at your side, but do not miss out the examination opportunity if you are preparing well for the exams. Okay, so that was the thing I wanted to add it, because in my every class I am motivating my students not to engage with the distracting words. Okay, so let's now move on to the next slide, payback period. Here we go for the payback period question. A project, a project needs initial investment amounted $200,000. You are required to calculate the non-discounted payback period. You are required to calculate the non-discounted payback period. Non-discounted means simple payback period, no consideration of time value of money. Okay, no consideration of time value of money. These are my expected future cash inflows. This $200,000 is my initial investment, that is year zero. That means investment. Okay. Now, in year one, 25,000 expected, 25,000, 120, 80, and 150,000. See how I will be calculating the non-discounted payback period. That is, I will be writing here years, cash flows, and cumulative cash flows. Cumulative cash flows. Cumulative cash means total. Just focus on the calculation how I am doing here. Year zero, my cash flow is 200,000 negative. So my total 200,000 is in negative form. $200,000 is in negative form. Okay. Now see year one, year two, year three, and so and so. If I will be having 25,000 in year one, see my main focus is to recover the initial investment. My main focus is to recover this amount, not the excess surplus amount. I am interested that in which the time period in which I can be recovering my initial investment, that is the $200,000. Year one, if I will be having dollar 25,000, then cumulatively add it, minus 200 plus 25,000 is equal to minus 175,000. That means from $200,000, that is from $200,000, that is from $200,000, dollar 175,000 is remaining. Okay, then if I will be having plus 25,000 more, plus 25,000 more on my investment, then how much I will be remaining left? 150,000. Okay, then what about next? If in the next year, if I will be having dollar 120,000 in a positive, then I will be left with dollar minus 150. Minus 150 plus 120 is equal to minus 30. Still my investment is left, because so far I have earned 25, 25, 50, and 120. 120 plus 25 plus 25 is equal to 170. That means 30 is left. And now year 4 is something different. Year 4 is something different. I will be having plus 80,000. That means now I will be having minus 30 plus 80. That will be positive 50,000. And you know what? My payback period is in between year 3 and year 4. My payback period is in between year 3 and year 4. Payback period is between year 3 and year 4. Okay, but we need to calculate number of months as well. See, there are 12 months in 1 year. I have to recover 30,000 from this 80,000. focus on my calculation. I have to recover this 30,000 from 80,000. Year 3 and year 4, that is minus 30,000, and in year 4, 80,000. That means now I have to recover $30,000 from 80,000. Okay, that is from 80,000. So that means 30,000 from 80,000. Divide by 80,000, multiply by 12. So 30 upon 80 multiplied by 12. That is giving me 4.5. Why 12? Because it shows months. So 4.5 months. Now you can say that your payback period is 3 years and 4.5 months. Or ignoring the months, if I will be simply dividing, or if I will be simply dividing 30,000 divided by 80,000, 30 divided by 80, that is 0.375. So your payback period will also be termed as payback period is 3.375 years. Now see the option, it will be either like that way or like that way. This is simply the trick in order to calculate the payback period. Payback period is the expected time period in which your initial amount will be recovered according to your estimations. I'm waiting 20 to 30 seconds for you people if you need to copy this thing. Okay, let's now move on to the next uh, technique, and the next technique is the payback period, and that is the discounted cash flows. DCF means the discounted cash flows. DCF means the discounted cash flows. Okay, so payback period, we need to calculate the payback period based on the discounted cash flows. See what is written here. It's same payback period. It's same payback period is same, but with working on the discounted cash flows, that is payback period by considering the time value of money. Now what we have to do, we have to calculate that present value first. The cost of capital is 6%, initial investment is 150,000, and these are my inflows, cash inflows, and that all are the future values. That all are the future values. Okay, that all are the future values, and I need to calculate the present value first, and then we have to calculate the payback period. Okay, So let's now start working. First of all, years, then cash flows, future value, then discount factors, and then present values. Okay. And then present values. And then the next point is the cumulative present values. Cumulative means total. Cumulative means total. Okay. Now, year zero. Cash flow is 150,000. Discount factor is always 1, and that is 150,000. First of all, we need to calculate the present value of all the cash inflows. That's year 1, 30,000. Year 2, 32,000. Year 3, 180,000. Year 4, 190,000. I guess we do not need year 5, but still let's see. The discount factor is of 6%. The discount factor is of 6%. So do not use this sheet. This is annuity factor. Use this sheet. Discount rate, discount factors. I am removing the marks from here, the highlighted areas. We need 6%, and here it is the 6%. 1, 2, 3, 4. Okay, 0.943, 0.943, 0.890, 0.840, 0.792. So here we will be calculating the present values. And I am now using my manual calculator, and so should you. 30,000 multiplied by 0.943. That's, make it round off. If it is, if it will be in in 2 or 3 digits, make it round off. 28,290. 30,000 multiplied by 32,000 multiplied by 0.890. That's 28,480. 180 multiplied by 840. That's 151,200. 190 multiplied by 0.792. 150,480. Now let's make it total. Now let's make it total. I'm using black color for the total. That's total 150,000 negative. Just add it. 28290. That is 121,710. And then plus 28480. 230 negative. And that is 151,200. That is positive 57,970. This is now positive, and we have to recover it from here. We have to recover it from here. No, here it is positive. Sorry, we have to recover this 93,000 from here. See always the last negative figure. When it is positive, stop. And we do not now need these year 4 calculations. So I'm removing it. Okay. So see the last negative figure. So my payback period is between year 2 and year 3. And if you need to calculate exactly the months, sorry, if you need to calculate exactly the months, so simply last negative figure, that's minus 93 230 upon 151 200, but ignore the sign while dividing because you want to recover this from this. You want to recover. Multiply by 12. So 93,230 divided by 151,200. multiply by 12. It's giving me 7.4 months. So you can say your payback period is 2 years and 7.4 months. Okay. Or if you simply divide, ignoring the multiply by 12, so you can say that your payback period is 2.93230 divided by 151,200. 93230 divided by 151,200, that will be 0.62, so 2.62 years. You can also write that way. So this is the payback period, but discounted cash flows payback period considers the time value of money. Okay, now move to the next note. I want to say something. That's payback period. Payback period. For example, payback period, if it is simple, that means non-discounted. Non-discounted. For example, so let's say after year one, it would be plus 15,000. I will be working on this figure. Let's say if it is DCF, discounted, if it is discounted, so after year one, it would be less than 15%. Imagine, let's say, for example, at um, let's say at 9% after 1 year. It's just an example. I just need to say one thing here. In order to say this, I need to explain through calculative examples. So if it is on 9%, 0.917, so it will be 15,000 multiplied by 0.917. So that is 15,000 multiplied by 0.917. That means it would be 13,755. Okay, I will be working on this figure, and I will be working on this figure if there are two different things. So my payback period from non-discounted cash flows will be earlier. Why earlier? Because the amounts are heavy, because the amounts are larger in amount. This is 15,000 more amount, and this is 13,000, which is the less amount. So remember one thing, that remember one point, that point to be noted is that payback period using DCF, I mean discounted cash flows, is less than payback period using simple non-discounted cash flows. So remember this statement. It might be helpful in your examination, that payback period using the discounted cash flow is less. Sorry, it's more. Sorry, it's more. It's more. Sorry, payback period using the discounted cash flow is more than, is more. This is less payback period. and this is more payback period. I mistakenly wrote less. It's more. Using discounted cash flows, the payback period is more than the simple cash flows. Okay. It's high payback period. It's less payback period because the amount is more. I hope this statement is well understood. Now, students, the time comes for the okay, Sad. Sad, see that if you are working on 15,000 figures, the simple figures 15,000, you can recover your initial investment early. Okay, if you are working on a discounted cash flow that is 13,000, that means the amount is low. That means slowly and gradually you will be receiving recovering your initial investment. So it will be high payback period over here, and here it will be less payback period. Let's say your initial investment is 30,000. Okay, let's say your initial investment is 30,000. So you will be having um, 2 years payback period if it is an annuity. Okay, if it is something like that way, so what's your payback period? It will be more than 2 years. If you want a calculative example, sure, I will be. It's understood, or shall I explain through some example? Is it clear, all of you? Clear? Okay, that's good. That's good. You can just simply use your calculator. Imagine that the initial investment is 30,000 and divided by 15,000. So the payback period is 2 years. If you will divide by 30,000 divided by 13,755, the payback period is more than the. Okay, all of you students, please reply here in the question box whether this statement is clear. All of you, all of you, all of you means all of you. Okay, that's nice. Now, students, we are going towards the case-based OTQ. We are going towards the case-based objective test question. And here it is on the next slide. I have left the space to show my calculation as well. See, first of all, I would like to uh, go through the complete question. Question number 1, worth 2 marks. Worth 2 marks. How many? 4 marks? 5, 6, 7, 8, 9, 10. Totaling 10 marks. Now this is something else. This is a different concept. And through all my today's webinar, it's my main objective to complete that topic, to complete this chapter. Space Limited is in the process of making the financial decision. Is in a process of making the financial decision, and following scenarios are in your attention. Part A, 2 marks. Calculate the effective annual rate of interest. What is effective annual rate interest? See, sometimes I'm writing something here. Interest may also be paid or received in less than 1 year. In less than 1 year. What do you exactly mean by the term effective annual rate of interest? Effective annual rate of interest means effective annual interest It means compounding effect on 1 year interest. This is a very helpful statement. Compounding effect on 1 year interest. See, the interest is 2.5% per quarter, and there are 4 quarters in a year. For example, 2.5, 2.5, 2.5, and 2.5. In total 1 year, there is 10%, and this 10% is free from compounding effect. It is free from compounding effect. It is known as nominal interest rate. It is known as nominal interest. But my compounded annual interest rate is more than 10%, because what will be happening? There will be 2.5% in quarter one, and in quarter two, it will be greater than 2.5% because of the compounding effect. And there is a simple formula for that. Capital R is equal to 1 plus I power minus n. I minus n minus 1, n minus 1, and then multiply by 100. My effective interest rate should be greater than 10% because of the compounding effect. Now, how I will be calculating this thing? See, R is equal to 1 plus I means 2.5%, and that 2.5% means divided by 100, that is 0.025. And what is n? N means number of periods in a year. Number of period in a year. And there are 4 quarters. And there are 4 quarters, so give the power of 4 minus 1 and then multiply by 100. You will be having your answer over here. That is effectively it's 10.38%. 10.38%. It is greater than 10%. Why? Because effective annual interest means in one quarter there will be interest percent. In next quarter there will be more interest. In next quarter there will be more and more and more and more interest. So the interest is more than 10%. And why we have taken this power 4? Because there are 4 quarters in a year. See, it is written number of period in a year, and there are 4 quarters in a year. In 1 year, in 1 year we have got 4 quarters. Okay, in 1 year we have got 4 quarters, and the nominal interest is 10%, 2.5, and greater than. So this is my effective annual interest rate. Azhar Ahmed, is it now clear? Because there are 4 quarters. If it would be monthly interest, so I will be taking the power of 12. Azhar Ahmed, I need your response. Is it now clear to you? Yup. Yeah. Yes, Mr. Azhar. So, okay, okay, that's great. So effective annual interest means compounding effect on 1 year interest if it is less than 1 year. Now, part B. So my answer is 10.38%. Now part B. Read this question, part B. The company had contacted a bank which adds interest monthly. See, the interest is on monthly to the investor's account, even though the interest rates are expressed in annual terms. The current interest rate is 18% nominal. Oh, 18% nominal annually. So that means 18% divided by 12. That means 18 upon 12. That is 1.5% per month. 1.5% per month. This is the monthly interest percentage. Monthly interest percent. 1.5% per month. Because it is given, it is in annual term. And this is something nominal. Nominal means no effect of compound. Compound means multiplier effect of the interest. Okay. Now, an investment deposit of 8,000 was made on July. The financial year end is 31st December. Financial year end is 31st December. Now, what is the requirement? How much investment? How much investment will worth by the end of 31st December? Consider the compounding effect. Can you people try to solve it? I'm not giving any time limitation, but be careful that we have 10 to 15 minutes left. So I'm giving you 3 to 4 minutes to think of this question and try to solve what is the exact answer. What could be the exact answer for this? And one thing more, as I have said yesterday, don't be afraid of the wrong and the right answer. You are responsible to give me the answer. Whether it is right or wrong, it's my responsibility to teach you. Okay, don't worry about the right and the wrong answer. Just calculate and drop your answer here in the question box. Okay, Saad Ahmed, I appreciate your efforts, but still I cannot confirm you whether your answer is right or wrong because I will be explaining. Okay, Shahlan Amir, probably your answer is right, but still you have to wait. What about the other students? Come on, you have to give your exam by yourself. I will not be present in the exam. Come on, try yourself. Okay, Fiona, again, I appreciated your efforts, but still, first, I need answers from all of you students. Keep trying, keep trying. Sweta, I think your answers uh, too much. The figure is too much. It's not 78,000. It's something like just retry because it will be 8,000 plus something. It could not be 78,000. Okay. Up till now, I can say that I have received the correct answer as well, but still there is some confusion to the students. Now see that you need to have, first of all, you need to have a compounded, this is 1.5 per month, all right? Now, see the time period of this question. See the time period of this question, students. See the time period. And I am happy with all the answers. Seriously, because I do not demotivate my students that you cannot even perform. At least you can try, and that's my duty to motivate you, to teach you as well. So I'm happy with all the answers because we have to make this session more interactive as well. So, but now you guys have to think critically on the time period. See what I'm doing here. It's 1st January, it's 1st July because I have made the investment on 1st July. And here it is 31st December. Okay. So this is not my time period. My concern time period is this. Concern time period. And how many months are there? Count July, August, September, October, November, December. That means 6 months. This is my time period, okay? Because I have made the investment on 1st July and it's being asked for the 31st December. And this is 1.5% per month. So now R is equal to 1 plus R is equal to, here is it is written the formula 1 plus 1.5 means 0.015 power 6 minus 1 multiplied by 100. So that will be giving me up to 2 decimals 9.34%. That's the compound interest, which is the effective compound interest, which is the effective for 6 months concerned. Because we are considered for the particular 6 months, and 8,000 is my principal amount and effective interest is 9.34% effective. Now just add it. 8,000 multiplied by 9.34%, and your correct answer is $8,747.2. That is your correct answer. Why we have taken the 6 months? Because we are concerned with the particular 6 months. It quite may be possible that most of the students have taken the power 12 here, taken the power 12 here. See the circle. It may be possible that you have taken the power 12, and that would be giving you the wrong answer. 19.56. So it's the wrong answer, okay? Why? Because 6 months is my concern time period. So I hope this addressed well. Yes, Mr. Azhar, you have got the correct answer. That's very good. One question from Mr. Saad Ahmed is that how do we distinguish when to apply effective rate of interest in the situation? Because it will be given in the question. See, it is given in the question 18% nominal, but we have to make it effective because the banks believes on the compounding effect. Nominal means no effect of compound. Nominal means no effect of compound. And we have to consider the compounding effect because the banks charge on the basis of consider the compounding effect. It is written in the question. All right. So now move on to the theoretical aspect of the questions. And part C here is that the following statements had been made about the finance trainee in your organization. You are required to make the statements correct or wrong. Number one, if IRR is less than the company's ROCE, return on capital employed, then the project should be accepted. The answer is wrong because IRR and ROCE, no link, no link at all. ROCE is the return on capital employed because it considers accounting profits, accounting figures, and IRR believes on cash flow, time, value of the money. So there is no link. There is no link at all. Okay. Now, number two statement, number one statement, number two statement. Company should accept that project which has minimum payback period. Students, come on to the question box. Is this statement right or wrong? Number two statement, is it right or wrong? It's right. Yes, it's right because we have to select that project which has minimum payback period. It's right. Number three, IRR does not consider the time value of money. Is it right or wrong? It's wrong because IRR considers the time value of money. Yes, that's very good. That's a very interactive students I am facing right now. Very good, all of you, because I always encourage the active participation from the students because it will not only increase your knowledge, it will increase your confidence level as well. Very good, very interactive people you are. Now, number four, in a simple interest, the amount of interest is multiplied based on the interest earned in the last year. In a simple interest means no compound. That's very good. Excellent. Excellent. It's wrong. It's wrong. It's wrong. All of you are giving me the right answer, and I'm very happy. Number five. Number five. Present value of perpetuity. I have to explain this thing. This is statement perpetuity. Wait a minute. I have to explain it perpetuity. Number six. Project appraisal consider cash flows relevant for the projects rather than working on the accounting profits. Is number six statement right or wrong? Number six. Yes, sir, it is right. Now I have to explain. Now I have to explain the concept of perpetuity and what is perpetuity. Perpetuity is a constant cash flow. Now you might be confusing constant cash flow. You may be confused that, sir, the constant cash flow is known as the annuity. Yes, you people are right. But annuity was for a defined time period. It's a constant cash flow, no time defined. Means I'm not sure whether it is for the 10 years, 12 years, just like you can say that when the government is paying the pension to the old age a person, now the time period is not defined. It will till the time when the person will die and no time period defined. So if anything is in perpetuity, so the present value of perpetuity is constant cash divided by interest percentage. Constant cash divided by interest percentage. And this thing is written right over here, that perpetuity is dividing the cash flow with the interest rate. This statement is right. So I appreciate that you people should note this thing. Okay, students. Now, first of all, I need a feedback, because for every trainer, the feedback is just like a fuel. If you will give me a feedback, the true feedback, it will be it will be like a fuel for the next session. Was this class interactive, and did you learn something? Give the honest feedback. If it is not good, just say it openly. Okay, that's good. If you find the session not interactive and not helpful, just give the feedback so that it will be helpful for the next improvement. But what I believe, that I made this session interactive. Yes, Mr. Azad, that was my main objective, that I should teach you all the things. And if you can analyze this session, that right from the time value of money, net present value, till the perpetuity, I have covered, alhamdulillah, each and every aspect of the chapter. Thank you so much, Fiona, Yusuf, and all of you who are giving the responses. And one thing more, I would like to say one thing again, that please avoid the distracting and the rumors around your corner, around it, around your surrounding, that regarding the examination remotely or the center-based exams. Just focus on the improvement. If you will be busy in the rumors, you will be you will remain busy in the rumors in your life. And I'm not concerned only for the ACCA papers, but I'm also saying that in every aspect of your life you face ups and downs. If there is no ups and downs, that means you are dead. Ups and downs are the part of the life. Similarly, the examinations are ups and downs. Do not be confused. Don't involve in such kind of negative responses. Just practice more, and just like practice just like that way, that your the exams will be remotely conducted. Okay, just do like that. If it will be remotely, go ahead. If it will be on center base, then go ahead. Just be positive and find out the positive solutions, which I have explained it earlier as well. Okay, so book your exams whenever you feel comfortable, that I am well prepared for the exam. I should take the 15th date, 16th date, 17th, or whatever the dates are available in your local area, in your area. So book your exams whenever you feel confident. Okay, and also stay connected with ACCA, clear your subscription as well. Okay, and tomorrow the next topic would be complete, inshallah ta'ala, standard costing and variances. I have already mentioned my day-wise plan. So tomorrow, the same time, same channel, and the same way to connect the webinar. See you tomorrow. Bye bye. Take care.